Hello and welcome to Accounting 2301, where we're bringing you the greatest hits again. Bringing you good old Chapter 10 with your host, Professor Naragon. And we're dealing with basically long-term liabilities, but specifically we're dealing with bonds. So, a bond is kind of like our notes payable. It is something of an interest-bearing note, but it requires a certain amount of payments to go with its face value, mostly known as a little bit of annuities and other items. This one we get to actually learn a little bit of time value money. Okay, so we're going to deal with one example already, as you can see in your notes. For example, we have a $1,000 bond, and it's got a coupon rate. Now, when we look at coupon rates, this is pretty much the interest rate that's going on. So, it's basically the cash interest rate, okay? So, we have a coupon rate of 8% that pays interest semi-annually, okay? So, this one say that we would actually be required about $40 that we actually have to pay out to whoever bought this bond. So how that figures out is, of course, 1,000 times the coupon rate divided by how many times we pay during the year. Well, we pay about $2 because we pay twice a year. And we repay that $1,000 at the maturity date. Now, again, companies will issue bonds basically so that they can get more investors in. There's probably something that's going on. I will tell you, a lot of times we'll hear this a lot with government and city bonds, like for the school, trying to get a little bit more money in so that they can build out more. With bonds, we do have to make a payment to these people. It's the incentive to buy these bonds. So we do have two rates. One, again, is the coupon rate, like in our example. And this rate is always stated on the bond. It does determine the amount of cash interest that will be paid. But we'll also have the market rate. Okay. Now, the market rate basically is what the market figures that should be, or if we get lucky, either it's going to be sold at a discount or premium. They will actually determine the price of the bond, how much somebody's willing to buy this bond. So we'll have three scenarios since we're doing with two items. One, of course, is the market rate when it equals the coupon rate. So if they're the same, then the bond sells for face value or for the principal. So bond for $1,000 will sell for $1,000. Market rate's 8%, coupon rate's 8%. Basically, investors are willing enough to actually buy the face value. Doesn't mean that the company's doing bad, doesn't mean the company's doing good, it's just investors are okay with it. Now, if somehow the market rate ends up being greater than the coupon rate, then a 1,000 bond will sell at a discount, basically less than $1,000. Okay, and it basically means the bond is not paying the market rate, so they're unwilling to pay full price for the bond. Just one of those things that they're just going, I like the bond, but I'm not willing to buy full price. So kind of like when we buy a product, we're waiting, we like the product, but we think the face price is bad, so we'll wait for it to go on clearance or on sale. That's what doing really at a discount is. Again, that's that sales discount that came back in Chapter 4. Now, the third scenario that you get is going to be basically known as when the coupon rate is greater than the market rate. Then that bond ends up selling for a premium, more than $1,000. So if it was a $1,000 bond, So from the investor's point of view, the bond is paying more than the market rate, so they're willing to buy more. So this is mostly a supply and demand thing. So like the Christmas times when you want to get that latest toy that's you can't find, or that latest product that's like hard to find. So you're willing to go on eBay to actually pay hundreds and hundreds of more dollars than what it's worth. That's what this is coming in. We see this and we go, oh dang, this is a really good company, or this is a really good bond. We better buy it before it goes. And sometimes, I mean, we do have this happening. So again, you got this nice little graph right here. Coupon rate, market rate, and again, little three things that go. So we're going to get into how to journalize a premium, how to journalize at par, and how to journalize it at discount. So, y'all thought you were getting out of journal. No. It's still coming. So, bond financing, when we actually finance with a bond, there is some advantages. One, it's not like a stock, does not affect owner's control. And interest on a bond is tax deductible. So we love anything time we can reduce our taxes. Woo woo. Bond can increase return on equity, which is nice too. Basically, it's helping us actually get more of a dividend, stuff like that. Disadvantages, bonds do require payments of both periodic interest and a par value at maturity. So we do pay out a little bit more than what the bond was when we issued, unless it's at a discount. We're good. Bonds can decrease return on equity. So they both have kind of like the return on equity, they can affect either way. So it just matters on that, how liquid the company is. Usually creditors or any lenders, they're going to watch out for that. They're going to see, can you still pay back this? Can you do this? And everything. So, it has its advantages and disadvantages, but we really want to just know, how do we journalize this stuff? Alright, so right now we have this example. We're going to start off with probably the easier of the three. Of course, when it equals. Okay, so we assume a corporation issues out a $100,000 5-year bond with 12% interest payable semi-annually. Alright, so first thing we have to do is record the issue of the bond. So when we record the issue, it's just as simple as when it equals cash. We receive the cash of 100,000, and we owe that face value of that bond of 100,000. So it goes to bonds payable. That's when it equals. Now, time to record the first payment. Well, it is paid semi-annually, so we're going to have 100,000 times 12%, and then we're going to have this little 5-year thing. So it's going to go for 5 years. So you're going to see this strange thing that's going to end up happening when we deal with discounts and premiums. But for us, when it equals, it's as simple as 100,000 times 12% divided by 2. Okay? And we keep going that for until end of time. Well, not end of time, at least until the 5 years is up. So you gotta go with how many payments you got for the year. So interest expense is $6,000 and cash is $6,000. So again, the cool thing is this is deductible for taxes. It just means we have to pay a little bit higher. Okay. Now, when the discount happens, remember this is when the market rate is greater than the coupon rate. Okay. Are you going to notice that we've issued it out for less than face value? Okay, or it's going to be less than 100%. Okay, so with this, we assume the corporation issues out a 100,000 5-year bond with 12% interest. This time, it gets for 96,400. So, first thing is we have to record the cash received of 96,406. We have the bonds payable. That is going to still always be face value. Will never change. Okay? It's always our face value, bonds payable. Okay? The next thing we got is our discount on bonds payable. This is going to be the difference of your cash and your bonds payable. Okay? So when we do the difference, we have to remember cash is less than bonds payable. Means discounts are always a debit. Okay? They're always a debit when we issue. You want to see something different that's about to happen though. Okay? So with this, when we make payments though, the discount or premium, once we get to the premium side, have to be amortized. Okay? This is where that lifespan I was telling you about comes in handy. Okay? So we will usually always use straight line amortization, especially for this class. Again, there's other ways to do this, but we're not going to get into it. So, straight line amortization, and it basically works like depreciation. We're going to take whatever the discount is and divide it by 5 years, which is the lifespan of the bond, but times by 2 times a year, how many payments we make during the year. So, basically, how many payments you do over the lifespan of the bond. For us, that's basically 3,594 divided by 10. And that will equal out to $359.40. So every time we make a payment, we're going to lower discount. So if we debit here, that means discount is going to receive a credit to make it go down. So here we go. We're going to record the first payment. I'm going to go ahead and show everything. So first off, cash is still $6,000. So just like here, it will always be the $6,000 right now, because it's still going to be 100,000 times 12% divided by 2. Okay, no matter what, it's going to be the interest payment. Next, we'll have the amortization of discount. Okay, since we already figured out it's $359.40. And again, it's lowering this. So if this increased by debit, it means it has to lower by a credit. Okay, basically what we're doing, this is what's going on, is every time we lower this, we're basically making it up to the actual face value from what the cash we've got. Okay, when we lower this, it's increasing the value of what we paid. Okay, basically we're balancing things out. The discount gave us too much. Okay, so with interest expense, all it is the total of these. Okay, so you're going to find this out when we actually do the Connect homework. You're going to see one problem what does try to balance things out and shows you how the movement is to balance to the face value of bonds payable. Okay, so face value of the bond. Okay, so again, the notes right there. Discount when we issue is a debit. When we pay, it's a credit. Okay, so third example is the issuance of a bond at premium. Okay, so again, this is when we receive more money than what the face value is. And sometimes you'll see this percentage and it's going to be higher than 100%. Okay, that means a premium has been taken in place. So it's going to look similar to the discount. First thing is, we record the cash that's been received. We're going to do our bond. And again, our bond is always on face value. And lastly, we record the premium. Now, premiums are always going to be a credit at issue because cash is greater than the face value. So again, the difference is going to be a credit. Remember, it has to stay in balance. So with this, again, we're going to do the same thing. We're going to amortize this. So again, on our straight line, we're going to take our amount, divide by 5 years, times 2 times a year. So we get $376.90 of the premium that must be amortized. So when you think about the journal entry, you're going to run into the same thing. First off, cash is still the interest payment. So the 100K times 12% divided by 2, it doesn't change. And then the rest, first off, our premium is now $37.6.90. Remember, again, we're trying to make basically premiums and discounts down to 0. So if it's a credit to issue it, it's going to be a debit to when we make the payments. So it's going to be a debit right here. So interest is now the difference of $6,000 minus whatever the premium is. So cash minus premium. And this will get us our interest expense. So we have to look at this and see how we're going to figure these out. Again, you have to take the scenarios the way they are. So the next thing that we're going to run into when we're dealing with bonds is that bonds have this kind of option to always get called back. Okay, unless it's right there that says it's a non-callback loan or bond. But convertible bonds, they can be called back. So what happens when a bond gets called back prematurely? Okay, so when this happens, you're going to end up seeing it being called back at about 98. This means basically 98% of face value. So every time you hear a call back at 98 or 80 or stuff like that, that's actually the percentage of the face value to call the bond back. So let's go assume this. On June 30th, a corporation has a bond issue of 100,000, like we know and love, outstanding, on which there is an unamortized premium of 4K. Okay, so premium still has 4,000 left to it. The corporation purchases 1/4 or 25,000 of the outstanding bond for 24,000. Record the entry for the purchase. Alright, so first thing that we want to do, of course, is the cash. We've paid cash out. So they now be, oh, alright, so I'm just going to show it all. I was hoping I can remember, but first thing you always want to do, of course, is the cash. Cash paid is automatically what we know. Next will be the actual bond payable. We know that they paid 25,000 for the bond, or basically that's the face value of the bond that they had. Okay. Now, with the premium is going to be $1,000. The reason why is that since we bought 1/4 of the basically bond back, we're able to take the unamortization of premium. We get to take 1/4 of that also. So 1/4 of 4,000 is $1,000. record this, you notice that it will be off balance. That this is 26,000 and we got 24,000 cash. This is where you see this gain on redemption of bonds. This gain on redemption on bonds is basically what is known as a plug account. And it only happens when there's a credit. Okay, when there's the difference and it's a credit when we actually buy back these bonds. So when we have this, again, all of it is a plug just to make sure that everything balances. Nothing really special. Find a difference and you're good to go. This, in fact, shows up on the income statement as an other income. Now, what would happen if they paid $27,000? So, if they paid $27,000, we have $26,000. That means we got $1,000 item missing, and it's not going to be a gain. It's actually going to be a loss. Okay. Again, now credits outweigh debits. If we did the cash and then the bond payable and premium, so we'll have a different plug called loss on redemption of bonds. So this is like we're selling our asset and we got a gain on it or we got a loss. Same thing with bonds, except we're buying it back. So when we buy it back, this time we paid more than what basically the face value of the bond was of the portion we bought back and the premium that would have been associated with that portion. So we can actually have a loss. And again, losses show up on the income statement, and this will be like an other expense. So we have to watch out for these. Okay? All it is figure out if it's going to be a gain, credit. If it's a loss, it's going to be a debit. That's the difference between our cash, our face value of the portion of the bond, and any amortization that happens. So, with Chapter 10, we come out now with a little bit of workout problems. And again, this is just basically going with just how do we journalize payments and the purchase back. So with this, starting off on June 30th, 2015, LJ Corp issues out a $1 million of 5-year 9% bonds at 97.3%. Okay, so this right here automatically tells me it's a discount. It's below 100%. Okay, so interest on the bond is payable semi-annually on December 31st and June 30th. Alright. First question is always going to ask, was the coupon rate 9% higher or lower than the market rate? It is going to be lower. Again, this is below 100%. It's a discount. It's lower. Okay. So first thing we have to do is do the issue of the bond. So for our cash, it will be the 1 million times the 97.36. Okay. So again, don't forget your dates. We did do this on June 30th. And the amount of cash we receive is $973,600. Sorry. Alright. So next journal entry that we have to write, of course, is our bond payable. Our next portion of this journal entry. Again, always do these two first. The cash and bond. Bond is always, again, at face value. Once we take the difference, notice right here, the debit is lower than the credit. So, again, this is a nice way to show you discount, because we have to balance this out. Alright, so next thing we have to do is journalize the entry to record the first interest payment. Alright, so first off, we have our cash. which is going to be the 1 million times 9% divided by 2. Okay? And there you go. So we got 45,000. Now we have the discount. Okay? So the discount itself, again, since this is a debit, it's going to fall into a credit portion. And remember, discount is amortized. So this is going to be 26,400 divided by however many payments we have. So we got 5 years times 2, or basically 10 actual payments. So, and I would say this again, if you're putting this in a calculator, always put the lifespan on payments, if you're using this exactly, in parentheses. Okay? Again, that's order of operations. Just so that you're okay. Okay? So we have 2,640. Our next step is actually record the interest. And the interest again is basically the combine of these two because there's no debit. Again, we have to make it balance. Next thing, little D right here. LJ Inc. decides to purchase all of its bonds back for $1,010,000. Okay, journalize the entry to record the redemption of the bonds. Alright, so we purchased back on December 31st, 2018. Notice that's about a 3-year difference going on right there. So, with this, I'm going to just show the journal entry. And you're going to notice you have a loss. Oh my. Alright, so starting off, you have cash of the 1,010,000. Okay, that's as much cash as that we paid out. Our bonds payable, again, is 1 million because it's the face value. Next is figuring out the discount. Okay, so our discount is 26,400, and this is a good way, minus whatever our payment is times how many payments. Now, you may have thought that it would have been 6. Well, no, it's actually 7. Okay, so you got December 31st, 2015, June 30th, 2016, December 31st, 2016, June 30th, 2017, December 31st, 2017, then you have June 30th of 2018, and since this is on December 31st, you have December 31st of 2018. It gets seven payments basically, okay? Because we still made the payment on December 31st because that was the thing. So, with that being said, we have 7,920. That's basically that's amortized. Our discount bonds payable. That's what's left. Okay, we actually have to still make it down to 0. So once this is said and done, we're going to notice credit outweighs the debit by a good old 17,920. So since we have to balance the debit side, we have a loss. Okay, so always watch out for this. Okay, and that's it with chapter 10. Again, we're just really focused on bonds for chapter 10, and we'll get back with you with the homework video so you can see how these are actually worked in problem form. Okay, so if you have any questions, please put a comment down below. I would be glad to hear from it, and I'll try to answer as soon as possible. Besides that, this has been another episode of Accounting 2301 with your host Nathan Aragon, Professor Aragon, signing off. I'll see y'all later.